The stock market and the companies that make up the major indices have changed drastically in the past several decades. But do you know how to manage the opportunities going forward? Today, we're diving into the future of stock investments and how you can navigate the changing landscape. Here's the problem. One of the key challenges investors face is keeping up with technological advancements, product and service innovations, and the market trends that impact investment decisions. Right now, we're living through a unique time in history where developments on multiple fronts are causing change to happen faster than we ever experienced in human history. If you think this isn't true, just look at the lifespan of companies over time as technology and innovation have accelerated over the decades. The lifespan of companies has been on a declining trend line, as you can see here. Let's explore together how you can take advantage of artificial intelligence, blockchain, new materials, robotics, genomics, and other rapidly changing technologies so you're not left in the dust. So how can you leverage these mega changes to optimize your portfolio to achieve your financial goals? Look, there are plenty of information resources out there to help you select individual stocks if that's the way you want to go, but it doesn't have to be that difficult. For example, you could just invest in the top 10 to 20 largest S&P 500 or NASDAQ 100 stocks and adjust your portfolio, let's say, once every year. This would keep you invested in the stocks that have outshined the others because they've fought their way to the top of that index. I'll also present a simple way for you to create a portfolio that will perform about as well or even better than the S&P 500, but with much lower risk using just 3 ETFs. The reason this method of using ETFs works is because the larger companies in the S&P 500 and NASDAQ 100 will most likely always benefit from the mega changes taking place right now. And if they don't, then they'll shrink to much smaller market capitalizations and become less significant contributors to the performance of these two indices. So what are we looking at right here? Well, if you've seen my previous videos, you'll know that this vertical axis is return, compound annual growth rate, and you can see it goes from plus 60% to minus 40% in this example. And then this horizontal axis is the maximum loss you would have incurred over the past 20-year time frame. So in this case, most likely in 2007 to 2009. And you can see that the S&P 500, represented by the ETF SPY, lost 55.19% of its value from its maximum sometime back in October of 2007 to the bottom, I think it was in March of 2009. That's a huge loss. So basically anything up and to the left up here is good. And as you get further to the right and down, that's bad, kind of represented by the colors here. So what are we looking at here? Well, I've created a very simple portfolio using 3 ETFs. And if you watch my video, The Ideal Portfolio Using ETFs, link in the pinned comments below, I walk through why you create a portfolio this way and how to do it. But we're going to do a brief version of that here. So what do I have? I've got 40% in safe haven assets. These are U.S. government treasuries. I have another 39% of my portfolio in what I call stable growth companies. These are consumer staple companies. So why are they safer? Well, when the economy goes to hell in a handbasket, you still got to buy toothpaste. You still got to buy razors for your shavers. You still have to buy medicine and drugs and all of those things that you need to live and food. These are consumer staple stocks represented here by the ETF XLP. And then 21% of the portfolio is in higher growth stocks represented by the NASDAQ 100. And you can see that here, this big green dot. Now, what happens when you combine the 3 of these together? Well, you end up with a portfolio that performs better than any of them. You can see that over here. Here's the portfolio. 100% of my assets. And by the way, these bubble sizes represent how much of the portfolio is in each one. So you can see this one's 21%, this one's 40%, and this one's 39% of the portfolio. So this is 100%. This is the entire portfolio. And you can see over this 20-year period, this portfolio had a 12.53% return, so almost as good as the S&P 500, which had a 13% return. But your maximum loss is less than half that of the S&P 500. So your maximum loss here is 19%. Now, you may look at that and go, wow, that's a lot. I don't want to lose that much. Well, you can adjust this and make it more conservative. But I'm showing you this to make a point here. You don't have to have a complicated portfolio to have an effective portfolio. And the importance of U.S. government treasuries is they add this nonlinearity in here, that the resultant portfolio over the long term will outperform the individual components, as you can see here. Oh, and one thing I almost forgot to point out, if you look at this portfolio, it has about the same loss characteristics as the aggregate bond index. There are no equities in the aggregate bond index. Now, there is some exposure to corporate risk because there's corporate bonds in the aggregate bond index, but people think of the aggregate bond index as a very safe investment. And you can see the maximum loss of this portfolio is about the same as the maximum loss of AGG, or the aggregate bond index, but the aggregate bond index only had about a 4% return, where this has over 3 times that amount of return. So this is a much better way to invest over the long term. So what have we learned today? Well, 3 things. 1, it's easy to manage your portfolio yourself with good long-term results. 2, you can take advantage of the huge technology shifts taking place right now without doing a ton of work and research. And 3, that benefiting from a simple 2 or 3 ETF portfolio can provide near or better returns than the S&P 500 over the long term, but even better with lower risk. The simple money management and portfolio ideas I just discussed could provide much more satisfying performance over the long term, both in terms of upside returns, but more importantly, in terms of downside losses. If you found this video helpful today, then don't miss out on future videos from my Invest Smarter channel. Take a moment to click on the subscribe button and share your thoughts in the comments section below. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.